Hello and welcome to another Smaulgld live stream. Tonight is Thursday night, November 29th, 2018. And tonight's topic is this economy supporting the stock market or vice versa? Or you could say, is the stock market supporting the economy? It's a question. But before we get to that question, let's take a look at what happened in our gold and silver markets and the equity markets and, of course, the crypto markets. Well, first of all, today was pretty much a flat day across the board. There was some volatility in the equity markets, but across the board, all indexes pretty much were flat. Now, gold, however, went up a little bit. You're going to see in a second. No. It went up a little bit. Not too much, but it went up a little bit. Yep, there it is. About $3. Went up $3. $3.21. Not bad. It's a quarter of a percentage point. It's up another 40 cents in the after hours, and it's up to about 12.24.30 according to Kitco. Now, silver, on the other hand, went down a little bit. Yep, just a little bit. It was at about 14.30 when it closed. And in the after hours, it's about 14.30. So very little movement here in the gold and silver markets, even though we had Jerome Powell, the Fed chair, somewhat back off of the gradual rate hike set path, as he announced yesterday in his speech to the New York Economic Club. So we're not really seeing much of a reaction to the speech in the gold and silver markets. And I covered that today in a interview I did with Silver Doctors with Elijah Johnson. That should probably be up tonight, probably tomorrow, about why the gold and silver markets did not react. Not going to go into that. We got a lot of other things that came up in the interview that I didn't get to cover, so we're going to cover those tonight. But let's take a look at the gold-silver ratio. Now, the gold-silver ratio went up a little bit. It's now close to 86 again. It's about 85.65. And that's it on the charts. So before we move from the charts, I'm going to treat you. Let's take a look at this is what you're going to look at probably for the rest of the night. As we spend a good amount of time together, let's take a look at we can either look at the 4 Smaulgld mugs, but I'd like to look at the big Smaulgld 22-ounce beer mug. I think it's wonderful looking. Now, should I do the left side or the right side? I think it looks better from the right side. So there you go. There's your beer stein, available at the Smaulgld store. If you want a Smaulgld Classic or Super Classic mug, you can order those directly. You can order everything directly from the Smaulgld website, but when you order the Classic and Super Classic mug, you get those from Smaulgld headquarters directly with a handwritten note signed by Mr. Smaulgld himself, packaged sometimes with an extra treat, like a Smaulgld Game Changer eraser. But I think now we are ready to hit our topic of the evening, and that topic, I believe, has something to do with, what are we talking about? We're talking about the stock market and the economy. Is there some type of link between those two? Are they supporting each other? What is the actual story there? Well, we're going to find out. Uh-oh, we got a moron here.
Presenting the distinguished international news commentator and foreign correspondent,
Smaulgld. This has been an extraordinary week in world affairs.
No, I told Hillary Clinton that that's moronic. I think the 1% got all the wealth.
All right. First off, whenever I talk about gold and silver, I always get someone in the comments is always getting very upset that I'm bashing gold or bashing silver and I'm working with the banksters. You got to realize I'm an analyst, not an advocate. And one of the things that came up in the interview I had with Silver Doctors today is I'd earlier on in the year did an interview and I suggested that the price of silver or gold would outdo silver. Now, many people in the precious metals communities have been saturated with the silver story. Silver is rarer than gold. You know, that whole thing with the gold-silver ratio is unsustainable. Silver is so useful in our lives. And so they feel akin to silver. It's their favorite asset. It's everything to them. And if you mention that it might not do as well, they get very angry. But again, I don't care because I haven't fallen in love with. And then some people say, "Oh, you're a crypto. You just want." I could care less. I'm an analyst, not an advocate, and that's what I hope you're here for. We're going to do some analysis of what's going on with the Fed, the stock market, the dollar index, and so on. But generally, in the gold and silver markets, and this is all data. We've looked at this. There's past YouTubes on it, past Smaulgld blog posts. Over the last 45 years, silver's gone down half of them. Gold's gone up about 64% of them. So there is a big difference. And one of the things is that when the markets, the precious metal markets are languishing or slightly bearish, silver's going to underperform. And that's basically what my analysis was this year. There's no catalyst for them to rise. Now, when they do rise, and if they begin to rise and they rise significantly, then silver will start to do a little better. But generally, those events don't happen every year, and we'll just see what happens. But this year, it looks like when I did that interview back in May, gold was $12.88. Now it's $12.22. That's only down about 5%. But silver was $16.38 at the time, and now it's $14.29. And that's down about 13%. All right, but the main point tonight is to talk about the stock market and the economy and the interplay between the two and, of course, the dollar. Now, we were talking about how the stock market reacted to Jerome Powell's comments, and basically the stock market looks for any excuse to rally. Good news is good news, bad news is good news is good news. It doesn't matter. Everything that they look at, they're always looking for a way to boost stock price, equities, and so on. And the gold markets didn't really react, nor did the silver markets. But one of the things that I've noticed over the past, since QE, since 2009, is, it's not that I've noticed this and no one else has noticed it, but there's a huge difference between the increase in the stock market and the increase in the actual economy. And the measure I'm going to use is GDP. Now, GDP is an imperfect measure. They count a lot of stuff in there that really shouldn't be counted, but it's a generic way of looking at the growth of an economy. In 2009, the Dow Jones was 8,500, and now it's about, 25,000. I think today it's at 25,338. But just use the 8,500 and the 25,000, and you basically have, almost to the note, 3 times increase. So from 2009 to 2018, the stock market has gone up threefold. The GDP from that period, however, the GDP in the United States was about $14.5 trillion in 2009, and last year was about $18 trillion, up about 25%. So you can see this huge difference. The economy is not roaring and growing at this rapid rate to necessarily justify an increase in the stock price. We know earnings haven't increased by that wide margin either. In fact, I think I saw the other day 25% of the stocks, I think on the NASDAQ or S&P 500, don't even have earnings. So there's not a lot of growth there, but yet there's massive stock market gains. And that's all by design. And the question is, can you decouple the stock market from the economy or the economy from the stock market? And, well, to do that, to answer that question, I'm going to take your thoughts in a minute, is what's boosting the stock market? Well, it's engineered. It's obviously not GDP growth. It's obviously not earnings. It's the fact that it's institutionalized that stock prices need to go higher. Why? Well, the Fed knows that its number one concern is to protect the dollar. That doesn't mean protect the dollar at a certain rate. The dollar index doesn't have to be 95, 92, 89, but there has to be confidence in the dollar so that people, or foreign sovereign entities and investors buy the U.S. treasuries, which are tied to the dollar, that countries use dollars in trade. They denominate their debt in dollars so that basically the dollar has confidence. And the way they do that is they keep the dollar within a range, and they try to come off as being a prudent central bank, a prudent steward of the dollar. And that's the reason that I suggested 3-4 years ago that the Fed would raise rates. They couldn't keep them at zero. They needed to entice people back, that they're not the most reckless bank on the planet, central bank, and they encouraged the Central Bank of Europe, the ECB, to do QE. That puts them in a bad light. Japan did some more QE and some bond buying after the Fed stopped their QE. So now the whole world is doing QE. They're at 0 or negative interest rates, and the Fed is there with its 2% interest rates. They're not doing QE. They're doing quantitative tightening. So they look prudent. That's exactly how they want to appear. The dollar is protected by the Fed. They know not to get too reckless, and if they want to be reckless, then they got to encourage the other central banks to be reckless as well, because it's all relative. Everyone's on a fiat standard, so the one that's the least reckless and the most prudent gets the kudos, and that's what the Fed is. And a lot of people get angry. Oh, the dollar is toilet paper. I'm not here to bash the dollar. I'm here to analyze what's going on, and that's the reason for the dollar hegemony. All right. So what's boosting the stock market is QE. Still, low interest rates are boosting the stock market. I mean, it's not like you're getting a big return if you put money in a bank. You may now be able to get a CD that pays 2 or 3%, but still, you're not even going to account for inflation with that. So people pour money into the stock markets institutionally. You got 401ks, IRAs, people pouring money into the stock market. It's a form of savings now, and you've also got central bank intervention. Swiss National Bank buys stocks. So you've seen over the last 20, 30, 40 years that the stock market is basically not necessarily a proxy for the economy, but actually is, in some respects, the economy, right? Because it's not so much that these companies are productive or that they're making money that gives them value. It's the fact that they're in the stock market that gives them value. You don't have to look any further than Tesla. Tesla doesn't make any money. It's almost out of money. And somehow it's got a $35 billion market cap. That would be inconceivable in a normal market where you look at valuations. It's that high. Swiss National Bank has Tesla shares. It's that high because it's speculative. It's that high because you have low interest rates and so on. Now, if you go and you say, well, the Fed did this, didn't they? And the answer is yes. Now, the Fed supposedly has, according to Jerome Powell and according to any of its documents, has a dual mandate of price stability and full employment. And they'll always tell you that the Fed has price stability. That's its number one thing. You know, the steward for the dollar, make sure that the inflation is only 2% or they have a rate. And then they add in a 78, full employment. The idea that they're interested in price stability is also, did we get cut off here? I hate when that happens. Yeah, buffering. Okay. It looks like it says it's reconnected. The idea that somehow, not me, are we there? It says I'm back on. See, I was on Jason's live stream there, but somebody needs to tell me if we're on. I can't tell. It says that we're on, but yeah. All right, well, I'm just going to talk, and if I'm not on, I'm not on. Okay, so maybe you can't hear me, and that's why you're not responding. Let's see. No, I don't see. All right. I was complaining that the Fed is talking about price stability, but actually what their goal has been is price inflation. And when I say price inflation, I don't mean that they've created inflation. I mean asset inflation. And this isn't just my analysis or interpretation. This comes from the words of first Ben Bernanke and Janet Yellen. Ben Bernanke said that the purpose of initiating QE was to create a wealth effect. And the reason you want to create a wealth effect is so that people feel wealthier and then they go out and they spend money. Okay, well, if that's what's happened, Janet Yellen agreed with that as well. Now, the wealth effect, if you're just going to boost asset prices, who's that going to help? It's going to help those who actually have assets. Those who don't have assets don't benefit from an increase in asset price. In fact, it makes those without assets unable to attain them. So houses are assets. If you don't have a house, making the housing prices more expensive, that doesn't do you any good. But if you already have a house and they boost the price, and you boost the price of houses, well, then those people are happy. So basically, it's the rich people or people with assets, and poor people don't have assets. So I would imply that people who have assets or rich people, they're the ones who benefit. People who have stocks, people who have bonds, people who have art, people who have houses, their assets go higher as a result of these policies. So again, they're not looking for price stability. They sound like for the last 10 years, they've been looking for price inflation, or more specifically, asset price inflation. And we've got that, as we've seen. The stock market up threefold in 10 years, GDP only up 25%. And housing prices, same thing. They're near all-time highs.